Welcome to this morning's Arizona Real Estate Market Report, brought to you live here at 8:30 in the morning on Monday. And as we've been expecting, the second week of January, we kept saying we're going to see how the market shakes out, or what are we seeing? Are we seeing any trends? Because you have to get past the holidays. Now, I'm going to arm you with information, let you know what's going on so that you can be an expert, and you'll also be a hit at all the cocktail parties. So as we go forward, looking at what's going on now in Arizona, the first thing I like to look at is the Cromford Market Index. And it is a proprietary index that is developed by Michael Orr, a mathematician who tracks our data here in Arizona. And while this looks kind of busy, the thing to point out is notice how all the arrows are green. This just means that the index went up last week. So anything over 110 is considered in favor of sellers, and anything below is a buyer's market. So you can see it's clearly a buyer's market down here in Maricopa, Buckeye, Queen Creek, Cave Creek, Paradise Valley, and Surprise, Goodyear, and almost Peoria. Fountain Hills and Chandler round out the top, where it's pretty advantageous for sellers. Now, having said that, it's really, it doesn't mean the market's either good or it's bad. It's a measurement of supply and demand. So what makes the Cromford Market Index go up? Well, it's either less supply, or it's more demand, or it's simply a combination of the two. So I like to go back and I like to check with my 7-day moving average and see what's going on this week. And here's what we see. This light line, the blue line, this is new listings, not active listings. You can see that we have 15,556 total listings available right now, which I'm going to show you is below last year's number. But it's interesting here that our new listings are starting to drop. And we're seeing that our new contracts, which is the blue line down below, or the dark line, while it has gone up, it's really not past what we would consider has been running at normal. We're sitting at 2,500 contracts. That's kind of where we've been, folks. So there's nothing, as you hear people say, new listings are coming. Here we go. There's a lot more choices out there. There really isn't. It's kind of stuck around 15 grand. Normal for this market is somewhere between 25 and 30,000 listings, but we haven't seen normal in 4 years, if then. So you're seeing here that new contracts are starting to increase. And if I go back a year, which is kind of hard to tell on this chart, but it's kind of the same pattern. We came out of the holidays and like being shot out of a cannon, and we continued to grow and grow last year. And then the sales continued to grow, but they were crawling out of the basement. So they weren't really growing. It wasn't really anything that was ultra aggressive. Now, if we look at our active listings here in the Phoenix market, this here shows 14,226. We went up by about 400 units for the week. And this pink line here, that's last year. So we're below last year, but not by much. Now, last year, we got a bunch of new listings, and then they started going down. In 2022, we had all these new listings because interest rates went from 3 to 7, and people ran for the hills and said, well, I need to grab my equity while I have it. So everybody listed their homes. And then they said, well, that didn't work. So they pulled them off the market. We had the highest number of expired at the end of December than I've ever seen in my life last year. If you look here again, well, I don't want to show that again, but here's the listing success rate. You listed your house. Did you sell it? This line right here is last year, 2023. We started out the year at 61.8%, which is not a great listing success rate. If you go back up to the peak here, 2021, 92.9. 92.9% of you listed your house and actually sold it. Right now, we just got this little blue dot. We're sitting at 70.2. So above average, but it's not knocking the doors down. Here's the interesting thing, though. Now, every January is when we typically, in this market, see the most listings come on board. Then we see the highest number of price reductions come in February. Well, why is that? Let me explain that to you for a second here, and then we'll go back to the chart. people are always optimistic at the first of the year. So they put their house on the market and they're waiting because, they're told it's a new year. People come out and buy like crazy. The holidays are over, and you'll see it. If you're looking at Facebook at all, you may see real estate agents going, here we go. Looks like it's going to be a busy market. Interest rates are down to 6.68. Well, by the time February rolls around, they go, well, that didn't work. There's too much competition out there. Let's lower the price. So most of the price reductions show up in February. Well, take a look at this. This is interesting. Price reduction spiked from this week, December 31st, to the first week of January. 1,733 homes lowered their price. Now, it's not up to where it was back here in 2023 of last year, but it's knocking on its door. There's October 2023. We had 2,110. But it's interesting to me to see price cuts show up this early, the first week of December. It's like they listed it on Monday, and on Friday they said, well, gee, nobody even came and looked at it. Let's bail. And there may be some of that. I don't know. I just want to continue to watch the numbers. Here's probably why we're seeing all those price cuts. Now, right here is the average list price that we had for most of last year, $364 per square foot. Now it's gone up to $371. Once again, seasonally sharing that optimism that everybody has in January. It happens every year. So it's not anything that says, boy, this is a wild and crazy market. Here we go. It's just kind of a, normal holiday, post-holiday run-up of listings. Now, let's talk interest rates for a moment, because that's what's driving the market. The bond market is what drives interest rate. The 10-year treasury. Mortgage rates pretty much mirror the 10-year treasury. 10-year treasury is bought and sold by bond traders. If they think interest rates are about to go down, they kind of run in and try to buy as many bonds as they can so they can lock in that higher rate before they go down. Makes sense. The more buyers you have buying bonds, the lower the yield, the lower the mortgage rates are. So we went from about 7.2 down to 6.6, and simply because the Fed chairman said, well, the numbers are looking better. Inflation's starting to tame down a little bit. And if we stay here, we may have rate cuts, possibly 3 next year, maybe starting in March. Good morning, AJ. But here's the kicker. They haven't touched anything. They haven't cut rates. The central bank has. The bond traders have already done their forward-looking approach and said, well, we're going to price this out 3 to 6 months. So by the time they get to March, if they cut, rates won't change because they're already anticipating that. So as you hear the chatter, there's going to be 3 to 6 cuts next year. Well, I don't know where the 6 is coming from. I think it may have showed up on a dot plot. One of the Fed people said, well, maybe 6. But they haven't done anything yet, folks. And the inflation report that came out last week was not nearly as encouraging on the CPI report as they had hoped, mainly because of shelter. Renting and purchasing homes has not got cheaper. Got cheaper? Is that the right way to say it? It's still expensive. So the bond market didn't react. They kind of yawned that off, says, oh, they're probably still going to cut. So as you wait for March, you're hearing people saying, boy, if we get to 5%, people are going to run for the hills. I mean, they're going to run out and buy all the available homes. And if we have tight inventory, here we go again. Now, why do we say that? Well, there are surveys out there that say that 70% of potential buyers say in this survey that if interest rates get to 5.5%, they will jump back in. So that's where that's coming from. That's why you're hearing a lot of that. What do I think? Do I think rates are going to get down to 5.5% anytime soon? No, I certainly don't see it in the first quarter of this year, January, February, March. I don't see it. I don't see it because the bond market's not indicating that we're headed that way. Rates have gone down and we've stayed here at 6.6 for about 3 weeks. And again, the central bank hasn't done anything. And so, it's hard to tell really where we're gonna end up. If I look at mortgage rates today, you can see the market is closed. So we're at 6.69. So we went down about 0.03 on Friday. But here's mortgage rates and where they've trended, but we're flatlining. So we're not doing anything that's fabulous. The rate trend on Friday was fairly positive, but it's not an aggressive move that looks like it's going to take you down to 5.5. So if you've got realtors telling you that's happening, remember, real estate agents are trained to manage you through the regulations and get the house sold. They are not, and I am not, experts on the bond market. We can guess, we can speculate. There can be crashers out there telling you that the 10-year, I told you it's going to be going crazy. Rates are going to start climbing back up, and here we go, everything's going to crash. They don't know either. Bond traders don't know. If they all knew, they'd all be rich. So we just sit back and we watch. I do like to look at what I call the Cromford Supply Index and Demand of Supply Index, but it only updates once a month. And I concentrate on this little area right here, which is the blue line is listings, and this red line coming down, these dots are demand. So, sales. So they met, and then they're starting to break up just a little bit. So in other words, it looked like it was going to start being more in favor for buyers, but that starting to go away. Good morning, Stephanie. Good to see you. And so as we wait for some type of indication of whether or not it's going to be a buyer's market, right now it looks like January and February is going to be a real snoozer. It's not going to be brisk. 2,500 listings over 7 days is not brisk. Where were we in 2021? We were running about 4,400 contracts over a 7-day period at a time when we only had 4,800 listings. Think about that. 4,800 total listings on the market. And every 7 days, we were writing 4,400 contracts. Gee, I wonder why prices went up. So now you're seeing 2,500 contracts written, and we're having new listings come on at about 3,700, but we have 15,000 listings available for everybody out there. And that contract ratio is hovering around 69, 70%. So when it gets down to 65%, in other words, new contracts versus new listings, and it stays there, then what we'll see is we'll start to see the price changes start to occur even more. And we're going to start seeing this number start to come down because people aren't going to be selling their house. So, and Sean says, I don't think I'll ever let my 2% rate go. You're right, Sean, and we're seeing more and more of that rate lock right now. Why aren't listings climbing right now? It's seasonally. They're supposed to be just flying, hitting the market like there's no tomorrow, and yet they're not. Why? Well, who's going to move? You're not going to give up a 3 for a 6 or a 2 for a 6, except in the new construction where these large these corporations have got a lot of money to buy your rate down, and they're doing it aggressively. And they're getting a break because of the lowering of lumber prices. So those lumber prices were factored in on their building costs. And now lumber prices have really come down. They have more money to be able to buy the rates down. Now, it was looking like it was getting tough when it was about 8%. That's going to cost them a lot of money to get you down in the 5s. Well, they got a break. They're down to 6.69 today. They're actually buying some rates down to like 4.99 for a long period of time, your entire contract. It's not a adjustable rate. Now, we've talked on here when I have Pat on Fridays about doing a 2-1 buy down or a 1-year buy down, buying down your rates and then refinancing later. Well, the question's out there that says, well, what if when it comes time for me to refinance, I've lost my equity? What is the ratio that I have to have of debt to equity in order to refinance this, which is usually about, you have to have at least 10% equity to be able to refi. There are programs out there that just look at your payments. They're there. It depends. I think FHA does that, but that's a good question. But keep in mind, that's got to be a pretty bad year or two for you to come down and lose all your equity. It's easier if you've only put 5% down. to go back in and refinance if things get soft. I've lived through several of those hiccups where you bought and you're sitting in your house and you're watching the equity go down, and then it eventually comes back up. You just have to ride it out. If you're planning on moving every 2 years, then you better not consider buying a house at all. So you just don't want to play the real estate market like the stock market. And unfortunately, a lot of people are doing that. Now, having said that, Wall Street is still very aggressive out there trying to get homes. And there's a bill in Congress that's been drafted that's probably not going to have any legs to it, just because they can't seem to pass anything these days. And this will tell investors that the law, in a nutshell, they're going to get taxed unless they divest of their investments in over a 10-year period to try and spur more inventory. Like everything else that comes out of Congress, is very complicated. I don't know what's going to happen. We're from the government. We're here to help. It usually has unintended consequences, but the Wall Street gobbling up of homes just exploded after the big crash of 2008. And so we're seeing more of that. And then this is pretty profound. A lot of conversations on YouTube as well. Do you see any indication short-term rentals will be forced to sell in the Phoenix market? By forced to sell, do you mean through regulation? I don't think so. I think there's too much money in short-term rentals for tax revenue and tourist revenue in Phoenix. Spring training's coming. I can't imagine that Phoenix is going to try and clamp down on that. Scottsdale is putting in more and more regulations just to try and cut down on the complaints and on the noise. And things like Paradise Valley, where you've got a beautiful house and they rent it out to 20 people and they've clogged the street with cars. We're going to see more and more of that regulation. There are cities that are trying to tax them to death. St. George, Utah pretty much lost all of their short-term rentals because of the regulations that they put in there, which is you have to be there in order to rent it. You have to be an on-site manager. And AJ's saying, yes, he's trying to see them regulated away. I don't think so. Small town I grew up in Washington State, Port Angeles, is interesting, is they're trying to regulate short-term rentals, and they put a moratorium on it while they examine it. And it really illustrates the mess and misinformation when they try to look at this. They're looking at the revenue, and it's huge. And this small town has a real shortage of hotel rooms. So Airbnbs are very, very popular. But they also cite this report that says that there were 100 complaints last year phoned into the police department on short-term rentals. That number is true. What they leave out is 70 of those phone calls came from one lady. The records are out there. This one lady calls and complains about Airbnbs all the time. And they have to write it down. So they have 100 complaints, 70 of them are her. Get a hobby, lady. And so they're trying to figure out how to regulate it and how not to have it grow. But there's this growing chorus that says, Airbnbs are why we have a homeless problem. I'm sorry. Airbnbs are great. They're really in good shape. You can put them all in the market. You can put them out of business and tell these investors that they got to sell them. Most Airbnbs are owned by, just families, individual investors. You can flood the market with them. Those are a popular product. They run on average here in Phoenix, $500,000 to $700,000. Tell me how that's going to solve the homeless problem. Will it solve inventory? Well, if it were to happen all at once, but the last time I added up how many Airbnbs we had and said, if we flood the market with all of them, guess what? We're still not up to what we consider normal housing inventory numbers in our market. So, it's not going to do what people think it's going to do. Good morning. And so there's three things out there that I see a lot here in our market. One is Airbnbs are going to flood the market. They're getting out. They're going to crash. New construction is building way too many homes, and there's a big crash coming. And then there's the silver tsunami. Baby boomers are going to end up in the nursing home, and their houses are going to hit the market. Well, I'm in the middle of that baby boomer age. Do I look like I'm ready to go to a nursing home anytime soon? So if you're waiting for me to go to long-term care, and that's part of your investment plan for buying real estate, you may want to find another plan. We're not planning on heading that way anytime soon. Now, the construction boom, I saw one just the other day. Look at all these homes. They're up in surprise. Oh my gosh, I can't believe how many homes there are. The average wage for Phoenix is way down here. Well, guess what? Um, the average wage for the chip plant in North Phoenix, which is where a lot of these employees are planning on moving, which is in surprise, is $88,000. It's not $48,000. So you got to look at all the numbers. You also have to drive up to 303 and look at all the new manufacturing plants and warehouses and shipping companies that are locating out there that is already spurring all this job growth. You can't just look at a development and go, oh my gosh, look at all these homes. Well, what's the absorption rate? In other words, how long is it taking them to clear those houses? Are they clearly just sitting there? Did you ask? Did you look up the numbers? So when you see these videos, ask for some data. I do. They're not going to answer it for me. This is husband works for the chip plant doing HVAC. Yeah, there's going to be a lot of jobs up there, isn't it? And you're waiting for the silver tsunami. No, I know you're not. You're just having fun with that. That chip plant's going to employ a lot of people, but it's not the only game out there. Now, does that mean I'm saying buy? The Phoenix market is just going to go crazy? No, anything can happen. I'm concerned about our banking situation right now. Commercial loans are starting to hit their books. Places like JP Morgan and Wells Fargo have set a lot of reserves, anticipating getting a lot of these leases and a lot of these buildings handed back to them. So they're trying to gear up for it. And so is the central bank. They're watching that closely. Will that create a banking crisis? I don't think so, but will it create some stress? Absolutely. I think it will create some stress and maybe make it harder for them to extend credit for you and I, as a lot of workers from different states are renting here and paying mortgage at their primary home in another state where the family lives. Yeah, I think when they come out here, and I agree with you, when they're out here working, they're not going to buy. They're going to stay in corporate housing, or they're going to rent, and they're making enough money to pay the mortgage back home and pay their rent here. When that's over, they'll be replaced with the workers who will want to buy. We see the same thing going on down in Chandler with those huge Intel plants. You ever get a chance, drive down Price Road south of Queen Creek and look at the huge cranes that are out there and how big that plant is. And Michael here says, Greece stars are in general, STV or short-term rentals are in very good shape. If they come to market in numbers, it will provide a good opportunity for buyers. I don't see them coming to market in droves. I really don't. If they are, they're trickling down. It's starting in Sedona. Sedona got oversaturated. So watch that market first. That's probably our biggest short-term rental market here in Arizona is Sedona. And that's a town of 7,000 people, I think it is. They have 1,000 Airbnbs, so it's way out of whack. And so the people that bought up there and wanted to get this cash flow, they're not finding it. They're finding that they're not getting the cash flow, so they're starting to put them on the market. So that will be your first indication of how much of an impact that's going to be on what can we see here. And AJ says, looking forward to the Wednesday roundtable. Yes, thanks for bringing that up. We have a lot of people that are going to be on that show. Find my little photo of our gang here. And we are going to be on Wednesday at 4 o'clock. Got my favorite people on here. We have Dan Frio, Pat, What's My Rate McMaster, Sean Shackelford, Jacqueline Smith, Caitlin McKaig. I know you all know her. This guy, I don't know who the heck he is. And we have Ruby Graff, and then we have our investor who's going to tell us what she's seeing in the investment world. And we're just going to do a roundtable Q&A. We're here if you want to ask us any questions. I don't know how long we're going to be on. Good morning. Welcome. And we have here, True, it'll definitely take a drive down that way. Yeah, you got to come down and take a look at in Ocotillo down at the Chandler plant. But getting back to short-term rentals, I think we can watch other cities before we get any indication what's going to go on in Phoenix. There's cities all over that are trying to clamp down on it. I think Arizona will be the last to add regulation. Because remember when they first came out, the governor said, no regulation, let the free market take it. Then he had to come out and go, well, we probably let that get a little bit too carried away. And so I'm okay if you start putting some reasonable regulations on them, and people have for the most part. But again, I think our real problem in our shortage is the fact that people are just staying put. We did have 30% of the market was investor driven, where they bought the homes and remodeled it. But they're looking for homes that are in distress, and then they're pouring a lot of money into it. The average, excuse me, first-time home buyer is not looking for that product. The average first-time home buyer right now, to be honest with you, is probably too picky. They want the granite countertops to be just right, or they want it to be quartz. They want the bathroom's got to be fixed up. It's got to be the latest in new trends and fixtures. They don't want to buy a house and put $125,000 into it. Some do, but not enough to change the market. And it's just the market that we're in. So if those investors, they may dump them, but right now the cash flow is good and the vacancy rate is good. That's why rents are not coming down. I'm looking forward to have you on Wednesday as well. It should be fun. We picked Wednesday at 4:00 because whenever you try to organize something like this, it's like herding cats. And that was really the only time we were able to get us all together. So, I mean, we thought about maybe doing it later in the evening, but it just didn't work out that way. Even so, even though we have this panel that's on there, something can come up where they got the phone call and they got to go unlock a house. So you just never know how many of us are going to show up. And in the meantime, I look forward to seeing you at Wednesday at 4:00. Have a fantastic day. Take on the week. Take care.